Okay, well, it's a IT heavy day, isn't it? I mean, Cyient, we had LTTS, and now we shift focus to Mphasis. The company reported a decent set of fourth quarter numbers. EBIT margins remained unchanged at 14.9%. To discuss this, now we're joined by Mphasis MD and CEO Nitin Rakesh and the CFO Manish Dugar, who's also with us. Gentlemen, good morning. Great to have both of you here as always. Prashant this side. Absolutely bang in line, Nitin, all numbers, revenues, margins, etc. But deal wins is what I want you to talk about to start. Here, you took in about nearly $180 million in new deals. And you described by saying that about 75-80% of this was from new generation services. So talk to us a little bit about that. And there has also been a little bit of concern whether deal win momentum is starting to slow down a little bit and how this will look like in FY25. Nitin, go on.
Sure, Prashant. Firstly, thanks for having us. I think for the full year, trailing 12 months, FY24 over 23, we had about a 5% expansion in total TCV, all net new. I think we had a bumper Q1, 700 plus million in deals in that quarter. Obviously, as that happens, you rebuild the pipeline through the phases and start converting. So that's one little nuance. We're still consuming a lot of that order book that we sold in the preceding 3 quarters, in addition to the 177 million we sold this quarter. Secondly, I think there's an interesting nuance that we've noticed in the last 3 or 4 months. The shorter duration, 0 to 10 million deals have picked up quite nicely. In fact, on a dollar basis, it's probably the highest we've seen in the last 4 quarters. That is an early sign for 2 things. One, some discretionary spend coming in. These are quick burst deals that convert to revenue very quick and give you in-year growth opportunity versus a large deal that is typically a 3, 4, 5-year deal and sometimes takes up to 6, 9, 12 months to ramp up to. So I think that's a nuance that you have to keep in mind as you think about that number per se. I think we're pretty confident that on a TTM average basis, we'll probably revert back to that kind of an average number over the next 4 quarters as well. Obviously, there will be some lumpiness in some of the larger deals between various quarters of FY25. So I think that's kind of where we are. We definitely are very pleased with the performance of Q4.
Right.
I think it's a great way to start a new financial year.
Is there a way to guide on the deal wins for 25?
I think it's a little difficult to guide on a quarterly or a full year basis, except that, as I mentioned, right, pipeline is up about 5% on a sequential basis. So that should give you a sense. And I think bulk of the deals in the pipeline are in 4 major areas. There's a pretty strong focus on AI-led ops, which is, how do you infuse tech into running operations, both IT and business. Customer experience transformation sits right there. Contact center is a very large focus area for transformation standpoint right now, especially for large banks because they have some really large operations in that space. We've also seen very big uptick in data modernization, data engineering deals because that's kind of a precursor to every enterprise trying to implement an AI solution. And finally, I think modernization is starting to pick up steam because clients are figuring out if there's a way for them to accelerate some of their programs around cloud and data using some of these new tech platforms because they are also they can also impact your operating costs and you can reallocate costs from one program to the next. So necessarily doesn't require additional funding.
Pressing on the deal point, I just wanted to ask you this. You said smaller and shorter duration deals have picked up. What number was that? $5 to $10 million?
0 to 10 million. Basically, less than $10 million deals. Less than $10 million deals.
Is this good news? Is this bad news? Does it mean that people don't want to commit to larger spends?
I think it's I would say, in light of pipeline expansion and large deal expansion in the pipeline, I don't think it is bad news. I think it's mostly good news because I'm reading that as, and we've seen that actually play out in Q4 as well as in the current quarter, that gives us the opportunity to see some early signs of quick spend or discretionary spend, which means you don't have to commit to a 3-year program. You got a $10 million funding or a $5 million funding. You want to implement a certain program and you're going to get done with it in the next 6-9 months or the first phase of the program. So I think it's a combination of a little bit more confidence on the client side to take up programs that necessarily don't require a large outlay. And by definition, consumption ability for these in the shorter duration is higher. So broadly, I think for us, at least we are seeing it as a positive.
Okay. I just had one more follow-up. So let me invite Manish into this conversation as well. And Nitin, thanks for joining in. Manish, the pipeline between BFS and non-BFS, right? How is it looking right now? Where are you seeing maximum amount of recovery come through in terms of orders?
At an overall level, pipeline has grown by 5 percentage points. And especially if I look at the BFS segment, there also we have seen, 19% growth. Uh, from a contract win perspective, we had called out that this quarter will be a quarter of growth led by BFS and TMT. And as Nitin mentioned, other than the fact that the overall size of the transaction, TCV and the pipeline has become bigger, we have also started seeing green shoots in terms of short-term deals and shorter deals, which actually contribute a lot more to the revenue in the immediate year. So overall basis, I think BFS has started showing signs of positive, from where we were maybe a couple of quarters back.
Okay, so BFS has started to show signs of being positive. Got it. On the margin front, what is the guidance right now for FY25?
On a reported basis, we will be in the range of 14.6% to 16%. And given that acquisitions are impacting almost by 1.1 percentage points right now, that translates to a range of 15.7 to 17.1% versus the 15.25 to 16.25 range that we had given for the last year. This is in keeping with our philosophy of margin being in a narrow and stable band while investing for growth with a northward bias as we gain scale.
Nitin, I just wanted your thoughts on a little more details on client spends, right? We were just having a word with Cyient, the management of Cyient, a couple of minutes ago, and they said that client spends have overall reduced and orders are seeing some delays. Are you noticing that as well? I mean, you spoke about shorter duration deals being picked up, but for the larger duration deals, are you noticing that client spends have reduced?
So I think, Sonia, what's going on is there is a reallocation of spend. On one hand, at least, 48% of our revenue is BFS, not including insurance. Banks are typically early adopters of almost all types of tech. I think they spent a lot of time over the last 12 months, especially around the whole Gen AI hype cycle, to explore areas where this can be most impactful. And I think at least the forward-leaning ones are at a point where they're realizing that they necessarily don't have to spend more to actually continue to apply into investment into their transformation programs. I gave you examples around IT operations, contact center operations. So there's a very strong focus on continuing to find cost optimization, 20, 25, 30% spend reduction in those areas where they necessarily don't need to spend that money with deployment of tech. That's opening up opportunities for firms like us because we also took a very forward-leaning approach on application of a Gen AI or an AI-based platform through the launch of Mphasis.ai. So that's one dynamic. Second, I think there is definitely some life that we are seeing coming out of the capital market segment in BFS, which was a very, very stressed segment for almost 2 years post the big IPO boom of 21 and early 22. I think as one major Wall Street CEO called out, that they're in the early phase of Wall Street reopening or capital markets reopening. I think that the earnings of major Wall Street banks have also reflected that. So that's definitely augurs well for at least that segment of the banks. Definitely not a lot to talk about on the macro related or interest rate sensitives around mortgages and all, because that's still fairly uncertain and hence very difficult to take a call on that. But there's a little bit of nuance depending on which segment of the clients you talk to, and hence I think we are taking a very, very bottoms up micro approach, account by account, deal by deal, opportunity by opportunity, and capability led.
All right, Nitin or Manish, any of you all can take this one. What about inorganic growth? There's plenty of talk that when things are uncertain, there could be a lot of consolidation. Are you all on the prowl? Should we hear about something in the first half of this fiscal?
It's very hard to put a timeline or a certainty on these kind of things. All I'll tell you is we've done about 5 or 6 transactions in the last 3 years. Almost all of them are capability led. We're trying to fulfill holes in our capability, build by partner. The last deal we did was October last year. We're kind of still integrating it, although bulk of that work is done. We're still, looking for opportunities, and as something bubbles up, we'll come back to you and inform you. Of course, capability, expansion of vertical, expansion of geo, all of those are on the docket, but very hard to say when something will fructify.
But if you're on the prowl, what could the targeted company be? What could be the rough acquisition size?
Again, it all depends on the the opportunity and the environment and the price and the strategic fit. So I don't think we've as such outlined a size of investment. And the last one we did was about 120 million enterprise value, about 65-70 million revenue. I think that definitely gives some heft and scale, especially if it's capability led. So I think we are, as I mentioned, we are very opportunistic, but at the same time we have a very clear idea of what areas will interest us.
All right, Nitin and Manish, great conversation as always. Thanks very much for joining us here on CNBC TV 18. Appreciate it. Well, that's sort of the roundup on the IT coverage this morning, with three companies giving you a fair sense of what's going on in that space.